Hi, everyone, and thank you for joining us. I'm excited to welcome Alden Schwartzer, who is the founder of Alden Investment Strategy and is a contributing analyst to LeoWadeTrader.net, covering equities and alternative investments. Ms. Alden, thanks for being here. The floor is yours.
Thanks for having me, and welcome everyone. So I'm going to go ahead and share my screen here. Moderator, can you stop sharing your screen so I can share mine? It won't let me. Okay, thank you. Let's see. So I'm going to talk about energy today, but first we're going to dive into inflation to some extent, because when we talk about commodity prices, particularly energy prices, there's two sets there. There's the numerator and then denominator, right? So one is we're comparing how scarce that commodity is, but we're also keeping track of the quality of the units that price is being denominated in. And so, right now, basically to give context where we are in the macro situation, our current situation in many ways looks like the 1940s. And I often use the concept of the long-term debt cycle, which was popularized by Ray Dalio, to show that we have a lot of similarities to that period. So we basically, unlike the 70s, where we had high inflation and high interest rates, we're in this environment where interest rates are pinned near zero, but because debt as a percentage of GDP is so high, so you have a high inflation, high fiscal deficits, but that they're still holding rates near zero, right? And so that's kind of a very unusual environment that you generally have to go back to the 1940s to find a similar type of environment. So, back then they had a private debt bubble. They recapitalized banks. You had a period of stagnation, economic stagnation throughout the 30s, and then you had that more inflationary, war finance type of decade. And then, we kind of had this echo of that situation. We had a big private debt bubble. You capitalized banks, and you had this decade of stagnation, not in terms of the stock market, but in terms of, say, real GDP growth was below trend, and labor participation was low. All these kind of more stagnationary type of variables, especially outside of the U.S., very slow global growth, and now we're kind of entering this more inflationary, fiscal-driven, almost wartime-like finance situation. Even though instead of a war, it's obviously other external catalysts. So that's kind of a macro backdrop. And this just highlights the difference between the 40s and the 70s, right? So 70s, you had high inflation, you had these waves of inflation, that's the blue line, and then you had waves of higher interest rates to try to offset that, that's the red line. And with the 40s, you had these periods of inflation, but you had almost you had a complete disconnect to interest rates. And so I view basically the 2020s as shaping up more like this type of environment where you won't get inflation in a straight line. And then also specifically that you'll have a big disconnect between rates and inflation. They won't necessarily be correlated in the same way that they were in the 70s. And we're already kind of seeing that play out, right? So we have the orange line here, short-term treasury bills, and then you have inflation going up to over 6%, official inflation, let alone other ways of measuring inflation. And so you have the biggest disconnect pretty much in modern history. And so that again goes back to the fact that because debt as a percentage of GDP so high, they can't do things like raise interest rates to 7%, right? When interest rates are when federal debt to GDP is that high. And so that's kind of the macro backdrop. Basically, my overall kind of direction points to a more inflationary 2020s decade. And that generally sets the backdrop for a decent commodity cycle, including an energy cycle. And so this chart shows 5-year cumulative CPI growth and 5-year cumulative oil price growth. And they're on different axes because oil is very volatile over that kind of period. But you see, basically, we had a huge inflationary spike for World War I. You had the 40s inflationary spike. You had the 70s inflationary spike. And then in the 2000s, because we were able to export a lot of our inflation, we had kind of peak globalization. You had that commodity spike, but you did not have really much of an inflationary spike. And then, we're kind of here now. We're a little bit off the chart now. We're here. We're kind of moving back up this direction. And so overall, we see the very strong correlation. It's pretty much almost an axiom that you can't really have high inflation without high commodity prices. They kind of drive what inflation is, or at least it's not really historical that you have high inflation without high commodity prices. And so basically, we've been in this kind of, obviously a huge bear market in commodities, including energy. We've been in this disinflationary trend, but now because of some of these other factors, especially the large fiscal stimulus that we're seeing, we're getting this more inflationary impulse, and we're getting more overall commodity demand. Another chart I have here shows our world and data's historical record with the sources listed here, showing the estimated world's energy usage over the past 200 years. And as we see, there's a couple interesting trends there. One is that we keep finding new energy sources that are generally more dense than the ones prior, but we don't actually replace the prior sources. We just add on top of them, right? So, we used to be heavily reliant on biomass, like burning wood. And since then, obviously, population grew a ton, and biomass went from being almost all of our energy to a very small percentage of our energy, but the absolute amount didn't go down. Same thing with coal, right? So coal grew very rapidly, and it's been in this period where it's just kind of going sideways. And you have to think of it in terms of globally, right? So let's say the United States winds down its coal usage, we still have rapid coal expansion in China and India and the rest of Southeast Asia. So oil is probably, in my expectation, going in a similar direction, where you might get to a point where it stops growing, but it's very hard to start pushing all this mix down. Then you have gas, you have nuclear, and then hydropower, and then everything we think of as like these new renewables like wind and solar are these tiny little colors here, right? So when you talk about kind of replacing oil, it's important to kind of keep the magnitude in mind and keep in mind this historical trend of how hard it is to replace energy sources on a global scale rather than add to them. This is just the long-term commodity cycle, right? So Rick Rule often points out, a well-known natural resource investor, that bear markets are the authors of bull markets and bull markets are the authors of bear markets. So, when commodity prices are high, everybody has an incentive to go and find more of that commodity. And then you inevitably oversupply the market, and then you get a big washout bear market. Companies go bankrupt. There's no incentive to find more of that commodity, and eventually you dwindle your existing supplies. Demand keeps growing over time until you get that next price signal. Prices start moving up. You get the next commodity bull period, and that eventually draws in more capital. And these have generally gone in these kind of 10, 15, 20-year cycles. And so what this shows is basically the long-term kind of rolling moving average of commodity prices, percent gains or drawdowns over time. So obviously, just like this previous chart showed here for oil, this is obviously oil is a big part of this, but this is multiple commodities, and we've been in this kind of really deep bear market, similar to the 80s, similar to the 30s, just deep bear market. And then what this chart shows is the NASDAQ 100, but instead of priced in dollars, it's priced in barrels of oil. And I have a log scale there. And so over time, what we see is that, as you'd expect, tech stocks gain in value compared to oil, because these are these long-term compounders. They grow wealth, whereas oil is just a commodity, right? So you expect equities to outperform oil, but it's not in a straight line. And so we see generally periods of, during an inflationary decade, these strong commodity decades, you have huge outperformance of oil versus the NASDAQ, where you can basically say the NASDAQ's going down as priced in oil. And then during a more disinflationary trend, tech stocks are obviously the place to be. They crush oil. They do phenomenally. And so in the prior to more inflationary decades, or more commodity-oriented decades, so the 2000s and the 70s, the NASDAQ did very poor versus oil. And this particular chart's a couple months old, and it's kind of down here now, right? So my contention is that we're in another downward cycle for that. So I don't think we're going back down to here, but we're I would say my base case is kind of this more structural correction for a period of time, because I do believe that we're entering another decent commodity cycle. And this can be, if we update it, up to say yesterday, this shows the S&P 500 sectors, right? So this is specifically the energy sector ETF, XLE, compared to the S&P 500. So whenever it's rising, it means energy is outperforming the broader market, and whenever it's going down, it means energy is underperforming the broader market. And what we see is that, of course, during that strong period, again, when you had the NASDAQ underperforming oil, you had energy outperforming the broad market, energy producers. But because you've been in this structural bear market for a while, it's given up all those gains, especially in mid 2020. It's bounced since then. So now we have essentially, it's no longer a falling knife, at least at the moment. And we see signs of that, may have bottomed and is potentially starting the next cycle. And if you go back to historical data sets, this period here, that was the lowest that the S&P 500 ever had in the energy sector. So only 2% of the market capitalization of the S&P 500 was invested in energy stocks. And it's back up to 3% now, which is still very, very far down the historical norm. And so, again, my base case is that because it's been such a long bear market, it's underinvested, and by studying that industry, I point towards a longer term energy bull market in the 2020s. And if we stop focusing cycles for a second and look at the secular trends, we see kind of a couple notable periods. So what this chart shows is U.S. oil production in absolute terms, and we saw that from the 1800s all up in the 1900s, standard oil, and then the breakup and all the major oil companies. Up until 1970, we had a structural growth in U.S. oil production, but eventually we ran into geological constraints, right? So conventional oil, we were still producing oil, but it was hard to keep producing more and more of that oil. And of course, that contributed heavily to the inflationary decade that followed in the 70s, right? Because we had, in addition to all the monetary policies like going off the gold standard, and fiscal spending and high bank lending, so increase the money supply, that ran into that physical constraint of we can only produce so much oil, and so now we have to import more of it. And of course, you had geopolitical issues that for some years prevented the importing of that oil. And so that was a very inflationary decade when you didn't have that structural trend of oil production going up and up and making it very abundant. And so it entered a long downturn. The U.S. became far more reliant on imports. And of course, that contributed to how entangled we got in the Middle East from a geopolitical standpoint. But then, with the combination of very low interest rates and some new technologies, we had the shale oil revolution. So we had another huge uptick in U.S. oil production. And the funny thing is that a lot of that was not profitable, right? So this big boom that happened was, basically the consumer was benefiting from that, cheaper oil prices, but the producers were essentially setting money on fire, and investors were just happily shoveling money into that fire. And so that was a very, very poor, they did well in terms of stock price for a long period of time, but their actual earnings and free cash flows generally were not very strong. And you had that blow up in 2015, 2016, and of course we had another blow up in 2020. So far, oil production has not recovered to its prior highs. And also during this whole period, especially this second leg up here, there was high grading going on. So basically they would tap into their easiest to reach energy sources. And so you can use the analogy of, you find a new pond and you start fishing in it. And first you catch a lot of the big easy fish, but then the more you fish in it, the harder it gets. Now you're down to the medium-sized fish, the smaller fish, the ones that are just inherently harder to catch because you already caught the easy ones. So going forward, there's a high probability that basically we've either topped out or nearly topped out just for, and again, geological constraints. And then of course we'll still be producing oil, but that we won't be benefiting from just unlimited oil, especially at without high prices to keep incentivizing that. And part of what changed is basically the combination of ESG mandates and investors getting tired of lighting money on fire. And so what this is EOG Resources balance sheet. And so that's actually been one of the more competent shale oil producers, right? So they've had a rough decade like anyone else, but these have generally been considered one of the more competent ones, some of the better returning ones, some of the more disciplined drillers. But even they showed that. So the purple line here is their net debt, so long-term debt minus cash equivalents. And what you saw is that they had this more stable situation, and during that whole shale buildup, they incurred a lot of leverage because they weren't free cash flow positive. They were basically taking on debt and drilling, and that was a common sentiment throughout the industry. EOG was actually like the less extreme in that regard than many others. And so you had this they were issuing equity, they were issuing debt, and investors, pensions, hedge funds, all the different sources of capital were happy to fuel that. And so you basically had investor fueled cheap oil. But that period's clearly over now. First, investors got tired of that just from losing money. And then two, when you have increasing ESG mandates, so that large pensions are divesting from the industry, and when many other pools of capital, endowments, things like that, They want to get their ESG score higher, so they avoid the space. One thing that's fun is if you look at, say, the tobacco stocks in the 90s, people decided that their, tobacco stocks are not no longer a growth industry. No one's going to invest in them. And they ironically went out to outperform the S&P 500 on average. The index of tobacco stocks crushed the S&P 500 since the 90s. And the reason for that is because they were super cheap. And they're pretty much barred from advertising, so they locked in their customer bases. And they just used all their free cash flow to pay high dividends and buy back their own shares at very cheap valuations. And so anyone who just held them compounded them. And so my contention is that oil stocks are kind of setting up to be the tobacco stocks of the next 15 years, where they might stay cheap, they'll be paying dividends, they'll be strengthening their balance sheet, and they'll just be grinding along, likely producing solid returns because you can have higher energy prices and a lack of investment. And so we saw, for example, with EOG here, is that in recent years they've been aggressively paying down their net debt. So now they're back to having a very strong balance sheet. And of course, they're a much larger company now as well. So they have as much debt as they had, net debt as they had over a decade ago, but also they have more assets and more cash flows. And so the orange line is debt to assets. So again, you can see it's kind of near the historical lows that this company's had. And another example would be Canadian Natural Resources. And again, so this is a lot of shale companies look like this. This is just a clean example. And a lot of companies also look like this. So this is a large oil producer in Canada. They have diversified sources. So rather than being shale focused, they're oil sands focused, and then they also have offshore oil as well. So they're more diversified in that regard. And what you see is that during the oil boom of the 2000s, this is their stock price. So the stock price did marvelous. But the green area is their free cash flow. And so it is all investment. It was just any money that came in the door just went back into the ground, essentially. And that was a trend for a very long period of time. But again, now because of ESG mandates and because investors are no longer rewarding growth in this sector. So before, whenever they would announce growth projects, whenever they would get more into the space, investors would view that positively and want to invest more. The stock price would go up. Now, whenever you look at slide decks of oil companies, they're always talking about how super disciplined they are. It's almost like a comparison to see who can drill the least, right? So they want to only drill on the best projects, and they want to focus on returning cash to shareholder returns. It's kind of a new emphasis for the whole industry. And so what you see is just mountains of free cash flow, but the stock price is behaving like it was those years ago. So even though you had a big rebound from the depths of that, right? So I'm not necessarily say pounding the table on the stock the same way as I was here, but structurally, you have rising dividends, you have all this free cash flow, and you have basically this situation where they're just positioned well for the next decade. And so if I were to show this chart for EOG, you'd have pretty much the same thing. You'd have this long period of not really being free cash flow positive, and now they're just making tons of free cash flow. And of course, there will be periods where they reinvest and continue that growth. But overall, that's kind of the regime that I see that we're in now. This more like oil stocks being a lot like tobacco stocks, where all the fundamentals are there, they make sense, they're super cheap, but that just due to various mandates, investing mandates, they're not heavily allocated to. And so as long-term dividend compounders and buyback compounders and strengthening balance sheet compounders, many of them are well positioned. And when you look at, say, overall kind of, we've had a period of underinvestment over the past 5 years, and that because, we either have already tapped out or getting close to tapping out this big shale push we're having, we're probably entering a period where, it's just, we're structurally more tight than we were over this past decade in terms of our energy supply. And unlike this time where, when the US reduced oil exposure, oil production, the rest of the world was there to kind of pick up the slack. So they could have this big growth in oil production, but now they're in the same boat. So everyone's kind of at the same time kind of starting to peak out. Not necessarily a hard peak, but basically that it's just it's much harder. It's like being on a treadmill if you want to get global oil production much higher than it is now. And so overall, I view us in a more structurally high priced environment. And that ends my core presentation. If we have time, I'm happy to take questions.
All right. Well, thank you very much. That was a great presentation. Do you have an opinion on CVX, PAA, XOM, and COP?
So yeah, basically, those are a lot of the oil majors, like Chevron and some of the others. And overall, I'm pretty much bullish across the board. I generally prefer these longer term compounding ones, right? So during this period here, right? So when oil stocks were super cheap, you could buy like the worst company out there, and then it would go up like 4x, and then you get out of it. But when we're talking longer term, I do like some of the larger ones. And so uh, one thing that's different though is if you look at say ExxonMobil or some of the other big ones, their balance sheet's not necessarily quite as strong as you have with say EOG here. Many of them still do have higher net debt levels. It depends on the company. So for example, Chevron has a better balance sheet than ExxonMobil. Um, but overall, I do like the oil majors in addition to the large pure play explorers. And so I view both of those as a viable combination. And for investors that don't mind jurisdictional risk, the oil major that I've liked the best for the past few years is Lukoil of Russia, and they're managed in a Western style. So their board of directors is basically the whole company's managed. It's not state owned. It's managed like it is anywhere else. And if actually historically they've been better managed than most oil majors, they've outperformed them mainly because they didn't make dumb acquisitions, right? So that's kind of a trend in the industry. You make acquisitions at the top, you destroy capital, and then you write them down later. Whereas Lukoil just didn't do that, and they have large inside ownership, and so they have very low debt, very low valuations. But of course, there's jurisdictional risk of owning a Russian company, even if that particular Russian company is not associated, strongly with the government. And so overall, I like to spread out my jurisdictional exposure and focus on ones generally that have decent balance sheets, low cost production, long reserves, and then a couple of shale companies here and there like EOG.
All right. Thank you. OPEC says no more oil supply deficit come Q1 as more oil comes online from OPEC and demand growth dissipates. Do you have any thoughts?
So I do. I think so. The reason I called my presentation for the long term, energy for the long term, is because I do think that in the near term, we could see some choppiness in energy, right? So inflation starting to get on the magazine covers, energy shortages are on the magazine covers. And so that's why I say I'm pounding the table less on the trade now than I was last year. But I think we have to be very cautious about timeframes. So I can say, for example, that I think that energy might be, I have no strong opinion on energy over the next 6 months, next 12 months. But my overall kind of higher conviction point is that 5, 10 years, this is likely a very strong sector to be in. So it's not something I'd rush out and necessarily overweight right away. But I think it's something that investors have to have on their radar if they're not already allocated, and basically look into some of these long-term prospects. So I think it's one of those things where investors are maybe overly bullish in the near term and yet not bullish enough in the long term. That's how I'd phrase it.
Thank you. Do you have a forecast for oil prices in 2022?
Not specifically, because it's going to depend on various actions. It's going to depend on fiscal stimulus or lack thereof from multiple countries. It's going to depend partially on Chinese economic performance. And so overall, there's a lot of, at the margins, there's a lot of human decisions you'd have to predict, political decisions you'd have to predict in order to have a strong opinion on that. So overall, my base case is roughly choppy and sideways, and neither lower prices nor higher prices would surprise me. And instead, what I'm focusing on is that longer term view and those producers that are positioned to get through these temporary bear markets, right? So I'd be more concerned if EOG had a ton of debt, but because they've already strengthened their balance sheet and their profitable current prices, I think they're well positioned. And so same thing for Canadian Natural or the other oil companies I invest in. I structure them so that they can get through that portfolio can get through a bear market and still kind of benefit from that longer term opportunity if that opportunity does continue to present itself.
All right. Do you have any insights into the offshore sector in particular?
So I do think that we're probably going to see a revival there. If you have years of kind of tight energy, it starts to encourage that type of growth. The thing there is that, so especially over the past 5 years, in this 6 years in this strong energy bear market, especially when you hear talk about electric vehicles and things like that. There's a lot of emphasis on short payback projects like shale, and it's very hard to invest billions of dollars into a project that it'll take years to get online and has like a 7 to 10 year payback period. And so that's why I've seen so little offshore oil production. And there's even companies that went bankrupt in that space. So another way to play this is to basically invest in some of the rig companies that basically provide the picks and shovels to oil companies as they go out and get that oil. So I do think that we'll see a leveling off of the damage that happened to that industry, and at least a partial revival, because as shale kind of, I think, long-term runs into headwinds, and as some of these onshore conventional resources can only get so far, we'll see them increasingly turning to offshore when you have that more persistent period of higher energy prices.
Thanks. Do you see uranium as a long-term energy play?
Yes, I've been bullish on that since October 2020. I've been writing about that as well. I think that it accompanies an oil portfolio very well. If you look at this chart, for example, we had this growth in nuclear, and then it just leveled off because you had a number of incidents. You had people kind of turning away from it. But just from my analysis of the industry, I find it very hard to have a future that is, say, less carbon intensive without nuclear playing a sizable role there. And we saw, China has an interest in building 150 nuclear reactors over the next 15 years. And so we might not see a lot of nuclear energy come to the West, but the East and the Middle East and Eastern Europe, those types, mainly in the emerging markets, is where we're kind of seeing that suggested nuclear growth over the next 10 years. And so I am pretty bullish on uranium.
Thanks. What are your thoughts on the midstream and pipelines in general?
I'm also bullish on those. I prefer to, again, stick to the higher quality of that stack. So I like Enterprise Products Partners. I like Magellan. Enbridge is trickier, but I'm bullish on Enbridge. Essentially, what you get there is, a lot of them have these long-term fixed rate debts that are currently below the inflation rate. They're yielding below the inflation rate, while their revenues can generally adjust, based on contracts variably with inflation. They're not very price sensitive to oil itself, as long as their capital structures are well done. So they avoid like the Kinder Morgan blow up, that kind of scenario, right? So as long as they have low debt, or at least for the industry, low debt. So I prefer to stick to the ones with the highest credit ratings, the one with the most conservative balance sheets, and I do view them as essentially long term. You're not going to necessarily get a lot of excitement out of them, but I do think that many of them have sustainable high distribution yields. And so basically in this environment where bond yields are 1.5% or so, I think essentially certain types of value stocks that pay higher dividends are better bond proxies than bonds, as long as investors are willing to put up with more volatility, obviously.
Thank you. Any thoughts on the European oil majors compared to the US oil majors?
So I do like diversifying my risk in terms of jurisdictions. And so I like US, Canadian, European, and Russian. With Europe, you generally get somewhat lower valuations compared to US counterparts. But you possibly face more regulatory risk, a little bit more hostile regulatory environment. And so my overall way is to kind of diversify that jurisdictional exposure. Another thing you can do is simply buy long dated oil futures. So if you buy 2025 oil contracts, for example, you basically avoid company risk and bet directly on the commodity itself. So I think there are multiple ways to play it. And my main way is I have certain metrics that I look for, but I'm not tied to any one company very specifically. It's more about the whole play of higher energy prices, and energy companies probably doing pretty well.
Building off of that, do you recommend XLE?
So I don't use it myself. I don't have any issue with it. I prefer iShares. I think it's IXC. iShares has a global energy ETF that I prefer. And so that gives you, a lot of it's the same companies in XLE, but then you also have some of those European majors, some of the Canadian majors. I like that diversification more than XLE personally. And I also like selecting individual players.
All right, thanks. And what about natural gas?
So I do like producers that have a good chunk of natural gas. It's still got a growth ahead of it. It's basically it's higher on this stack of basically better energy source, longer term. Even when you say shift to electrical vehicles, they still use grid energy, right? So, and a lot of our grids are powered by natural gas in the West. In the East, it's more coal oriented. And so electrical vehicles are essentially indirectly natural gas vehicles in many jurisdictions. So I'm very bullish on natural gas longer term. Obviously, it's more volatile than oil in the shorter term, and it's very hard to find attractive long-term compounding companies that mostly do natural gas. So I like the ones that have that mix, that they oil and gas mixed together. It's a very attractive combination.
All right, thanks. And we have time for one last question here from Paul. I failed to buy EOG when you first recommended it. Is it a buy here or better to wait for a pullback?
I think it depends on time frame. I think looking back 5 years from now, I'd be happy with EOG at current prices, but I could easily see it lower 6 months. But it's also possible we just never get that pullback. And so overall, it kind of ties into my thing where I'm not aggressively pounding the table saying like this is the best trade over the next 6 months. Don't be surprised if we do see lower prices. But I do view overall this period as a accumulation period, right? So, and I might not go max allocation at current prices, but I personally would have an allocation, and I would consider just gradually adding that allocation over time. So I'm not tied to any one particular entry price. And then instead, as long as I continue to view it as an attractive valuation, I'm happy to continue putting capital in there and leaving some of a buffer. So if we do get a large correction, let's say we have a big macro event in 2020, we have a big deflationary period, that'd be a good rebalancing event to maybe take some dry powder and put it into that sector. So I personally am long EOG, just not necessarily max long.
All right, well, thank you very much. That was a fascinating presentation. We really appreciate your time.
Thank you. Happy to do it.
And thank you to everyone for joining us as well.